Thanks, Adrian. Morning, everybody. Wednesday morning, pretty drenched everywhere. For those of you who are North Yorkshire, Morpeth, Hebden Bridge, absolute nightmare. I've got mates of mine up in Newcastle. Not pretty. September, amazing month, really. Morning, everybody. Hi there, Jeff, Jeremy. Thanks. Morning to you all. Just extraordinary, really. I mean, not weather-wise. Weather-wise is a nightmare. I mean, listening to poor folk in some of these places that have had floods 6 times this month. I mean, this summer. And this month is just the icing on the cake for some of those people. Just extraordinary. The wettest September now for 30 years. The worst storm for 30 years. God knows, not pretty, but there we go. Anyway, why am I mentioning that? Well, September, actually, is drawing to a close, as Adrian was just saying. Not only is September, the month, drawing to the close, but obviously the quarter is drawing to the close, and it's been an interesting quarter, as you all know. We started with extreme stresses in the market. The breakup trade really was to the fore. A lot of hedge funds were targeting the weaker peripheral zones, speculating on a potential breakup of the Eurozone. So you had bond yields in Italy, Spain, obviously Greece, Portugal, Ireland are out of sight anyway. So there was a lot of heightened expectation about a breakup of the euro in some fashion. Obviously, the powers that be, the ECB, the IMF, and certainly the core members, that's the likes of France and Germany, did not want that to happen. A lot of political toing and froing, negotiations between the ECB, the IMF, and obviously the core countries, notably Germany, who ends up having to pick up the bill, has resulted in what we've seen. All the bad news was in the market in July, beginning of July, and effectively, they've managed to manipulate it, and it started with that speech by Draghi in London just before the main Olympics in late July, which has culminated in a significant improvement in the markets. You're probably wondering why, or why I'm mentioning this more to the point, because September was the culmination. We had the speculation, we had the big build-up to what these central banks were going to do to support growth and certainly within the Eurozone, what the ECB was going to do to resolve the crisis here. And to a certain extent, the talk has done it. But now the focus is on action. I noticed a very interesting article in the FT. I don't know whether I've actually got it up here at the moment. Okay, well, yeah, there's a little article about the central bank firepower here. So this actually sums it up. And the reason I want to just mention this before passing you back to Adrian, so my piece is not going to be that long, but it does sum it up. We've had the main central banks, the world's top bankers, trying to what effectively they're getting into is a big monetary experiment, something that's never been done before. But then again, we've never had a financial crisis, credit crunch, liquidity crisis that started in 2008. We've never experienced that before. So this is something that central bankers are having to feel their way through, really. The European Central Bank has engaged in this bond buying program without limit. That was passed by the Germans as well, so that's yet to be used, but that's the firepower ready to be rolled out. The Fed has announced this open-ended asset purchase program, which is really to help the labour market. And then we heard last week about the Bank of Japan has announced a further aggressive expansion of its monetary policy easing. So they're all at it. They're all at it. Why then? Why are the markets then starting to fall? Why are the markets now backing and filling? Trends reversed. We were looking at the euro on Monday, if you recall. I don't know where we got cable here. Let's go to a daily, weekly, monthly. Let's just go to the euro. I've come in without my glasses. Can you believe it? So I'm sort of feeling my way through. Okay. That's the one. Okay, Monday, this is what we look like. And remember, this is what eventually happened. The market closed down on the day, so the 24th. But until that actually closed down, we were not sure quite what was happening. Remember when we were speaking on that Monday morning, we were sort of bobbing around the sort of 129.40, 129.50 level. Remember, it rallied a little bit. Jared, Adrian, euro, yen, swing long on it. Okay, we'll have a look at that just after my piece, Jared, if that's okay. Now, obviously, things have all turned. So we're in a bit of a move back down. Now, you can see where the potential is. You could see where the potential is when it broke up, when we had that big, do you remember when we had that big move up of 200 points or 180 points on this particular day? We've then rallied all the way up to the sort of resistance that we put in back in into the resistance lines, which were effectively support lines back in spring this year. And now we've failed. Now there's not a lot to hold it coming all the way back again to here. So for those of you who are wanting to know where the sort of potential sort of limits are on this particular move, I mean, we could be swinging between sort of 126.5 and 130 for the foreseeable future. Anyway, what happened last night? Does anyone know why the market span off? I heard Adrian saying, the FTSE was due sharply lower. Ian, doesn't all this government intervention just delay the global decline? Ian, that's interesting. Ian's asked, with all this central bank intervention, is this just a way of just slowing things up? I think, actually, to a certain extent, that is a very good point, Ian. I do think a lot of what the central banks do, they try to smooth out market moves, but can they actually change the course of the market? Well, they can in the short to medium term, but longer term, wealth has to be created. The banks don't create the wealth. We create the wealth by our endeavours. It's not done by central bankers printing money, withdrawing money from circulation, etc., etc. So, it's down to our endeavours. Sandeep, Monti's not going for a re-election in Italy. Market falling after that. There's a lot of stuff going on. I agree with you, Sandeep. Sandeep's saying that Mario Monti won't be going for a re-election. Well, he's sort of a caretaker, really, isn't he, Sandeep? Ian, could this all lead to hyperinflation in the future? Okay, interesting point. You won't have seen this, and I can't show you it now, but look at the front page of the FT. There are a number of hedge funds, comments in the press, and I can't find it here. Hedge funds, okay, if you just look down here, hedge funds skeptics warn on QE infinity. Basically what they're saying is they're not altogether sure quite what the result of this is going to be. And it's quite interesting. There was one of the reasons why the markets fell overnight is because of this chap Charles Plosser, who is a non-voting member of the Federal Reserve, who basically said he's not sure about what effect this QE3 is going to have. He's actually got a speech. He had a speech prepared in Philadelphia. He's the Federal Reserve Bank of Philadelphia's president, and he said that the central bank's latest round of monetary policy easing was unlikely to help growth. Oh my God, why the hell have they done it? I mean, this is a massive gamble. Going back to that comment about inflation, Ian, yes, inflation, it's hugely inflationary. Remember, if you've got constant demand for any good, whether it be copper, sugar, cocoa, or even dollars, and you increase the supply of them, first of all, you'll weaken that price, but also you'll increase the actual amount of that instrument in circulation. So more dollars in circulation, we know what happens. Inflation is a function of the velocity and supply of money. So the more money that's in circulation, the greater the pressure on inflation, because obviously people are able to pay more for goods and services. There's not so much sensitivity to it, and it could lead to hyperinflation. It's a word that I wouldn't use just yet, but it could lead to it in the years to come. The question is, how do the central banks and all these bankers reverse everything they put into place. As I said to you at the beginning of this piece, this is the greatest monetary experiment of all time. So how it turns out, I don't know. But it's interesting to see these sort of headlines, hedge fund skeptics warn on QE infinity, and this chap Prosser stating, he's one of the members of the Federal Reserve, this is the FOMC, they set the interest rate policy and make decisions on monetary policy and they've got two mandates, not just interest rates, but also the labour market. So unlike our MPC here in the UK and the ECB in Europe, the Federal Reserve's rate-setting committee, the FOMC, have two mandates. But, you know, now the question marks are starting to appear. Things are not getting any better, though, you know, in the short term. Obviously, this is a longer-term play. But this chap Plosser from the Federal Reserve's the Federal Reserve Bank of Philadelphia, he said that we're unlikely to see much benefit to growth or to employment from further asset purchases. And he said this in the prepared speech. So, you know, this is the doubt. This is coming from actually the Federal Reserve's committee. It wasn't 100% in favour of it. David, David, keep asking these questions. Adrian's going to come back to you in about 5 minutes, and we'll go through some of these questions. David's question on gold, and Jared's question on euro yen. Okay, inflation, VV important. A lot of stuff also going on today. You'll probably have heard the news about the succession problems in Spain. We understand that Catalonia, they're calling a snap election there. They want independence, etc., etc. So that's caused a bit of a ripple in the markets. But I don't think that came out at about 7 o'clock last night. I think the major moves in the market were down to the sudden turnaround in the US market. Wasn't really currency affecting at the time. It was more equities, and the equities spun off quite sharply. So everyone who was following the FTSE at the time, if you're following the rolling cash or rolling future, you'd have seen the market spin off a good sort of 30 or 40 points. We really opened in line this morning where we were sort of 9 o'clock last night. So just more of the same. In the long-term bears, prophecies seem to be slowly coming to light. Well, it is. I got to say, Ian, part of the problem is it's difficult to. I hate to sound like a doomsayer, but you know, we're following the pattern that happened in the 1930s. After the crash, during the Depression, no one trusted currencies. There was a big, rush into gold, something tangible, property. But currencies are just worthless bits of paper. And to a certain extent, that's sort of what we've seen here. We've had two crises. We've had the banking crisis sorted out by governments, and then we've had the sovereign debt crisis, i.e. governments being called into question. And now there are concerns that the central banks, who are weakening their balance sheets by acquiring all sorts of dodgy assets, they maybe have to be recapitalized in the future. We're not out of the woods anything like yet. And we have got, 1, 2, 3 years to go. Confidence, at least we've sort of been told by the European Central Bank and the European Commission that the euro is here to stay. At what cost? At this stage, they haven't had to dip into the piggy bank just yet, but sure enough, they will do at some stage. Listen, I've got to finish in a second, but those are the headlines. Just remember, we've got one of the reasons why I mentioned inflation. If we just go to, sorry, I should have gone to trend signal first here. Just going to look at the data coming out today. We've spoke about it on Monday. It's the most important, one of the most important bits of data out this week. So we click on economic calendar. It comes out at midday. This is the German CPI. This is their inflation data. Germans are paranoid about inflation, absolutely paranoid. The older folk will have distant memories of what happened when the Reichsmark, the Deutschmark that became, they had hyperinflation and their currency was just absolutely worthless, which just goes to show you the policy of printing money can create that hyperinflation where it just gets totally out of control. But those memories have lasted a long time, and Germans especially are very, very sensitive to inflation. And that's one of the reasons why they're very, very anti the bond buying program of the ECB. And it's something they've really reluctantly agreed to with real stringent conditions attached. So we will wait and see when that particular facility is tapped. Anyway, we've got the CPI out today. We're looking at a fairly sort of flat number. It says all day. I think it comes out at midday, actually. Ian, I'm with the Austrian economist. No government intervention at all. Okay. Austrian or Australian? Long-term bears profits. Robert Prechter has been calling for a major decline for years. Robert Prechter, I have to say, Ian, God, I remember him in the 80s. He was calling for a significant fall in the property market, and I remember thinking, shall I buy a flat? Shall I not? And eventually I sort of jumped in, and I can't remember ever seeing a property decline of any significance, but a lot. I mean, he's very bright guy and closely followed, but some of those calls in the market are not calls for us right now. They may be longer-term calls, of course. Okay, Tim, that's it, really. I'd like to pass you back to Adrian because he wants to discuss more of the trades coming up. But thanks for listening. Good luck for the rest of the week. And we will be on with you again Monday morning. Thanks very much.